Across the brokers that are required to publish their data, somewhere between 50 and 90% of retail trading accounts lose money. That's a wide range, and it varies depending on the asset, the platform, and the period measured. But the consistency of that range across years and markets tells you something important. Trading is hard, and a big part of why it's hard is that price charts can look like patterns and signals and setups, when really, underneath all of that, there's a much more fundamental process happening that most people never fully get to grips with. This video is about that process. Not to make you profitable overnight, understanding this won't do that, but it will give you a clearer picture of what you're actually looking at when you open a chart. Before we get into it, if you're looking to start your investing journey in the UK with a head start, check out the link in the description for the best platform sign-up deals, including up to £500 in free shares. Not financial advice, capital at risk. Now, price moves because of an imbalance between buyers and sellers. That is the foundation everything else is built on. When there are more buyers willing to buy at a given price than there are sellers willing to sell, price goes up. Sellers realize they can charge more, so they do. When there are more sellers than buyers, price falls, until it finds a level where buyers are prepared to step back in. That process of continuously finding where the two sides agree is called price discovery, and it runs constantly on every asset, in every market, every trading session. Every single candle on every chart you've ever looked at is that process playing out in real time. Take this move here. At that moment, the volume of sellers at that price level outweighed the volume of buyers. Supply overwhelmed demand. Price fell until it found a new level where buyers were prepared to absorb it and step back in. That's all it is. But understanding what causes those imbalances to form, that's where it gets interesting. There are four main drivers, and each one is worth understanding on its own terms. The first is fundamentals, the underlying performance or perceived value of what you're trading. When a company reports earnings that come in above analysts' expectations, demand for that stock often increases and price moves accordingly. But here's the nuance worth noting. Markets don't just price in what happens, they price in the gap between what happened and what was expected to happen. A company can post strong earnings and still see its stock fall if those results didn't beat the forecast by enough. It's the differential that moves price, not the result in isolation. The second driver is macroeconomic data. Interest rate decisions, inflation figures, employment numbers. These carry particular weight because they don't affect just one market. A single data release can simultaneously move stocks, gold, Forex, and crypto. Not necessarily in the same direction and not always by the same magnitude, but the mechanism is the same. The data shifts expectations around central bank policy, and those expectations transmit across asset classes. The third driver is market sentiment, the collective mood of market participants at any given time. Fear and confidence shift buying and selling behavior in ways that can be just as significant as hard data, and sentiment doesn't always wait for a fundamental reason to change. When the prevailing mood in a market shifts, imbalances form quickly and price reflects that shift. And the fourth driver is liquidity, where significant concentrations of orders sit within the market. Institutional participants and market makers operate at a scale that dwarfs retail activity, and understanding where large pools of orders are positioned and how price tends to interact with those areas is a concept we'll return to in more detail later in the series. Now, here's what ties all of this together and why it matters beyond any single chart. These four forces do not operate on individual assets in isolation. They connect. What moves gold affects the dollar. What affects the dollar flows through commodities and currencies. Risk sentiment in equity markets transmits directly into crypto. A single macro event can set off a chain reaction across multiple asset classes. So when you're watching a price move on TradingView and trying to understand what's driving it, you're rarely looking at something that exists in a vacuum. You're looking at the visible surface of something that's connected to a much wider set of forces. That's what this series is going to work through. The correlations between asset classes, how they influence each other, and what that context adds to your understanding of the charts you trade. First up, gold versus stocks. One of the most documented relationships in financial markets, and one that tells you a great deal about broader market conditions when you know what to look for. Make sure you're subscribed so you don't miss it. If you found today's episode useful, subscribing genuinely helps us keep making these videos. This information is not financial advice and is for educational purposes only. Always do your own research. Capital at risk.